Your job might be keeping you truly poor. Robert Kiyosaki always explained money with a different view. Most people work for a paycheck their entire lives. They think their house is their biggest asset, but it is not a true asset. It takes money out of your pocket. An asset puts money into your pocket. A liability takes money out. This is a crucial distinction. Rich people understand this deeply. Poor and middle class people often buy liabilities thinking they are assets. Like a fancy new car, it depreciates in value quickly. It costs thousands of dollars a year in insurance and maintenance, maybe $1,200 yearly for insurance. Another $1,500 for repairs. Over 10 years, that is $27,000 gone. That car is a liability. It never puts money back into your wallet. This thinking leads many to financial struggles. They might earn $60,000 a year, but their expenses also climb steadily. They have student loan debt of $50,000, credit card debt of $10,000, a mortgage of $300,000. All these are liabilities. They drain their income every single month. They might even have a second mortgage of $75,000. Their total liabilities could easily reach $435,000. This burden prevents them from accumulating true wealth. They spend 40 years working to pay off things that never truly enrich them. Rich people instead buy income-generating assets. They purchase a rental property. It costs $200,000, but it brings in $2,000 a month in rent. After expenses, perhaps $700 for taxes and maintenance, that is $1,300 profit each month. Over 12 months, that is $15,600 a year. This is how real wealth built. It is a slow process, but very powerful. They do not focus on trading time for money. They focus on acquiring assets that generate passive income. This allows them to step away from the daily grind. They aim for financial freedom, not just a bigger salary. Imagine owning 10 rental properties like this. That is $156,000 a year in passive income. This is enough for many to live comfortably. This strategy shifts their entire financial trajectory. It frees up their time for even more investing or for family, or they might invest in a small business for $50,000. It could generate $500 in profit monthly. This type of income is not dependent on their daily effort. It is like having money machines working for them around the clock. They seek out businesses that can scale rapidly. They might invest in a tech startup with the potential for 10x growth in 3 years. This is a fundamentally different approach to earning money. Their goal is always to increase their asset column. Every decision aims at adding more income streams. They look for a minimum 12% return on their capital. The second big idea involves financial education. Schools teach you to be an employee. They teach you to get a good job. They tell you to work hard. They tell you to save money. This is important for some, but not for wealth creation. Our education system does not teach about money. It does not teach about taxes. It does not teach about investing. It does not teach about building businesses. This is a massive gap. Rich parents teach their kids these things at home. They explain cash flow, they explain income statements, they explain balance sheets. Most children spend 16 years in traditional schooling. They learn almost nothing about money during those years. They graduate with high debt levels, maybe $70,000 in college loans. They then seek a secure job. They become a doctor or a lawyer. They earn a lot of money, but they often still struggle financially. They have high income, but also high expenses. They live in a big house. They drive expensive cars. Their liabilities grow with their income. This is the rat race. Robert Kiyosaki says, to escape the rat race, you must learn financial literacy. It is not about how much money you make. It is about how much money you keep. And how hard that money works for you. You need to understand how money truly moves. It is about understanding the rules of the game. They might spend $5,000 on a financial course, or hire a mentor for $2,000 a month for a year. This investment in knowledge yields massive returns. It is often a 20% or 30% return on their education investment. They read at least one finance book every single week. This translates to 52 books a year over 5 years. That is 260 books. Imagine the knowledge gained. They attend a minimum of 4 investment workshops annually, each costing around $750. A third major point revolves around taxes. The tax system is designed for the rich. It is not designed for employees. Employees earn money. They pay taxes first. Then they spend what is left. Business owners and investors operate differently. They earn money. They spend money on business expenses. They pay taxes on what is left after expenses. This is a huge advantage. They can deduct many things. They can deduct travel expenses. They can deduct office supplies. They can deduct vehicle costs. An employee cannot do these things. They pay maybe 25% of their income in taxes. A business owner might pay 10% effective tax rate. This difference is enormous over decades. Imagine two people. One is an employee earning $100,000 a year. They pay $25,000 in taxes. They have $75,000 left. The other person owns a business. They earn $100,000 too, but they deduct $40,000 in expenses. They only pay tax on $60,000. Their tax bill is perhaps $15,000. They have $85,000 left. This is a difference of $10,000 every year. Over 30 years, this is $300,000. This money can be invested, it can buy more assets, it accelerates wealth building incredibly fast. The government actually provides incentives for investors. These incentives are often hidden from the general public. They want people to create jobs and provide housing. They might claim depreciation on a building. This allows them to show a paper loss even when the property is generating cash. This strategy can reduce their taxable income by tens of thousands of dollars each year. It is a legal way to keep more of their earnings. They employ expert tax advisors. These advisors might cost $5,000 a year, but they save them $30,000 in taxes. That is a clear net gain. They also understand capital gains tax benefits. Holding investments for over 1 year can reduce their tax rate from 40% to 20%. Fourthly, rich people embrace debt. This might sound crazy. Most financial advice says avoid debt, but there is good debt and bad debt. Bad debt is consumer debt. It is credit card balances. It is car loans for personal use. It is anything that takes money out of your pocket. Good debt is different. Good debt is used to acquire assets. You borrow money to buy a rental property. That property generates income. The income covers the debt payment. It might even provide a profit. This is leverage. You use other people's money to make yourself rich. You might put down $50,000, you borrow $150,000, the property costs $200,000, it generates $12,000 a year in rent. The debt payment is maybe $8,000 a year, you still have $4,000 profit, and someone else is paying down your loan. This is a powerful concept. It allows you to buy more assets faster. It increases your return on investment. If you used all cash, you would only earn 6% on $200,000. But if you used $50,000 of your own money to control a $200,000 asset and it makes $4,000 profit and pays $8,000 in debt service, that is a much higher return on your $50,000. This is a 24% return on your initial cash. This is a huge difference. Most people are fearful of all debt, but rich people understand its power for growth. They know how to calculate risk. They borrow at 4% interest. Their asset returns 8%. That is a net gain of 4%. They might take out a $500,000 loan to buy an apartment complex. This complex brings in $75,000 in rent annually. The loan payments are $40,000 a year. That leaves $35,000 profit. This is smart debt. They manage a total debt portfolio of millions of dollars, but it is always asset-backed debt. Their debt-to-income ratio might be very high, but their asset-to-debt ratio is even higher. Finally, the rich take calculated risks. They do not avoid risk altogether. They manage it. They educate themselves. They understand market trends. They learn how to invest. They buy assets when prices are low. They sell when prices are high. They look for opportunities. Poor people often play it safe. They save money in a bank account, but inflation eats away at savings. If inflation is 3% a year, your money loses value. $100,000 in a savings account will only buy $97,000 worth of goods next year. After 10 years, it will be worth about $75,000. This is a silent killer of wealth. Rich people understand inflation. They invest in assets that grow faster than inflation. They invest in real estate. They invest in businesses. They invest in stocks. These assets can provide a 10% return annually, or even 15%. This outpaces inflation significantly. It grows their wealth over time. They are not afraid to learn new things. They are not afraid to make mistakes. They learn from their mistakes. They network with other rich people. They seek mentorship. They constantly expand their financial knowledge. They see problems as opportunities for new ventures. This mindset shift is one of the most important things. It changes everything about how you approach money. It is not about hard work alone. It is about working smart. It is about acquiring knowledge and applying it. It is a different game entirely. It is a new way of seeing the world. They actively seek out financial mentors and coaches. They spend maybe $10,000 a year on financial education programs. They read hundreds of books on investing and business. This continuous learning is crucial. They attend seminars, sometimes costing thousands of dollars to gain specific insights. They understand that their brain is their most valuable asset, and they're always investing in it. They might even fail several times, but each failure provides valuable lessons. They know that failure is part of the learning process. They adjust their strategies and try again. This resilience sets them apart from the average person. They are always seeking to innovate. They are always seeking to improve their financial position. They aim for complete control over their financial destiny. Not just a comfortable life, they target a 5% return on investment at minimum, but often they aim for 15 or 20% returns. This ensures their money is always growing faster than market averages. They might invest in 100 different assets over 30 years. Building a diversified portfolio is key for long-term security. They know exactly where every dollar goes and what it does for them. It is a strategic game. They track their net worth monthly. They review their financial statements quarterly. They adjust their investment strategy annually. They are always thinking 5, 10, 20 years ahead.